Good morning to everyone. Good afternoon to our participants from Asia. Thank you very much for being with us today. My name is Morgane Loisic, and I am in charge of sales and communication at TAC ECONOMICS. I am very delighted to welcome you today to this live webinar entitled China's Economy, How Close to the Cliff? Our objective today is to provide you with a clear and forward-looking view of the Chinese economy. To structure the discussion, we will begin with the major structural challenges and weaknesses China is facing, from slower growth and rising debt to rapid aging. We will then turn to signals from our quantitative tools which shed light on the risks of economic adjustments in the coming years. And finally, we will look at the implications for businesses and investors, including sector-specific opportunities and financial risks. After the presentation, we'll take time for your comments and questions, so please free to write them down in the chat box. A quick reminder, this webinar is being recorded and you'll receive the replay and slides later today to revisit or share with colleagues. And now it's my pleasure to introduce today's speaker, Thierry Apotheker, Chairman and founder of TAC ECONOMICS, who will guide us through this analysis. Thierry, the floor is yours.
Good morning, everybody. Thank you, Morgane, for the introduction. Indeed, I think that the timing of this webinar has been really triggered by our quantitative instrument, which for me is always part or a significant part of the value addition that we as analysts can bring to our clients. So the approach I'm taking, as you indicated, Morgane, is very straightforward. Some would say very candid. And very candid means that there are these structural weaknesses that China has displayed. And there is also simultaneously the very strong resilience capabilities that China has also displayed over the last 10 years. And this debate within China watchers between the structural weaknesses and the risk of falling off the cliff versus the ability of Chinese authority to manage the challenges and to muddle through with limited systemic problems, this debate has been with us at least for the last 10 years. I remember when in 2015, there has been this significant slowdown in China's growth with the same questions. Is the debt sustainable in a context of slowing growth? Or are the authorities able to steer their course across or amidst the difficulties? One thing, obviously, that everybody has noted also, that in this underlying debate that we have had all of Chinese watchers for the last 10 years, there has been the very critical, I would say, once in a century changes in the geopolitical environment. And these transformations have major implications on the question, on the debate, structural weaknesses versus resilience capabilities, making both the resilience more necessary and the weaknesses more dangerous. Now, in this uncertainty, very frankly, what can we bring to you in terms of value addition? I think most of the China watchers are inundated by contradictory signals, contradictory observation. We certainly, all of us, have some sort of cognitive biases where what we wish for has a stronger weight in our minds than what we are dreading. So in that sense, this is where our quote unquote unbiased quantitative instruments are very useful. And the reason that the real causal reason for this webinar is that over the last few months, we had a rare convergence that it's not, even in countries with huge difficulties, it's quite rare that we have simultaneously three completely different tools in our set of quantitative instruments that converge in telling us that there is a much higher risk of systemic shock, let's say around 2027 for China. So the bottom line of this presentation is fairly simple. The structural weakness versus resilience capabilities debate is still there. The difficulty of the debate has been reinforced by the geopolitical tensions in the strategic competition between China and the US and its repercussion. And in that uncertainty, we have three flags telling us, be careful. Now, once we say that, the question for you, financial investors, industrial companies, service companies, what do you do with that? And once again, I think it's in TAC Economics DNA to try to put ourselves in your shoes and derive from the macro analysis what's the kind of operational conclusion that we may suggest to you. And in this, then what? We have these flags pointing to a much more difficult transition year in 2027. So then what? One, the first thing that we have to be humble is that we may be wrong. And certainly there are many instances when we proved wrong. So this is certainly a likelihood, and we have to discuss that. If we're right, then there are a couple of different scenarios that I will not describe in detail, but certainly share our views on. And the last step, more important, is what does it mean in terms of industry, in terms of investment? And certainly there, I will insist on the huge heterogeneity within the China's economy today, both across sectors and across the different types of corporates. So that's the menu for this half hour together. And I will go through the different elements. For those who know me, the critical challenge is time management. So you will forgive if I don't get into the details in the formal presentations. But any questions, any need for clarification, please use the chat box and raise your questions. First thing, the structural weakness versus resilience. And there are many, like hundreds of pages that you can read on the subject. So I will be very short. And I use two charts that you have in your screen now. The one on the left, which is more kind of economists only type of chart, where we cross two indicators. On the horizontal axis, we have the so-called ICOR, incremental capital output ratio, which is a ratio which basically measures the efficiency of investment. How much extra GDP do you generate with 1 point of extra investment? The further you go on the right of these charts, the lowest the investment efficiency, the lowest the extra GDP generated by $1 of extra investment. On the vertical axis, we have a very simple element that most development economists use massively, which is the working age population as a proportion of total population. The higher the number, the stronger the potential growth of the economy, the lowest the number, more constraint on development. Now here we've taken 5-year averages for 3 countries, China in red, Vietnam in blue, Indonesia in dark blue. And the message, you can read it for yourself. China is the one only large country, whether in Asia or elsewhere, which is registering simultaneously a very sharp decline in efficiency of capital spending and a very sharp contraction in the working age population. Now you can turn the things in all the way you want. This spells much lower potential growth forward. And today, for instance, our own estimates are that the potential growth, the let's say medium-term growth that China should be expecting between now and 2030 is around 4.5%. Now, if you compare the last 5 years point of China versus Indonesia and Vietnam, you see that not only is the demographics much, let's say, has not the same trend in these two Asian countries, but more importantly, the investment remains much more efficient than in China. And in China, again, since the period of the first part of the century to now, there has been this permanent decline. So we are in a country where the excessive investments generate lower and lower output growth. And on the right-hand side, there is also something that everybody knows, that this investment-driven growth that China has been engineering for the last couple of decades with a diminishing return of investment spending, all this has been funded by debt. And the aggregate that the social authorities and statistical apparatus are using, this aggregate social financing, so bank lending and non-bank lending or non-bank financial resources for the global economy, private sector and public sector alike. As you see, as of June 2025, we have a ratio which is almost unheard of in any emerging markets, and even in highly indebted mature markets, you would not have these 315% of total debt to GDP. Now so you're in presence of a country that has relied excessively on investment, funded by excessive debt. This means that pressures on capacities, on excessive capacities, and pressures on prices are constant. And the pressures on prices and margins can or have the ability to initiate a vicious circle where debt becomes unsustainable because nominal growth in revenues declined significantly with lower fundamental growth or lower structural growth and permanent deflationary pressures related to excess capacities. So I think the diagnostic on the weaknesses is fairly straightforward. China is permanently on the cliff edge for this vicious circle where nominal growth is not enough to allow indebted economic agents, and we would say most importantly, local governments and corporates, to sustain their excessive level of debt. The second slide on the weaknesses versus resilience capabilities are more on the resilience capabilities today. That is, what's the cyclical pressures that in this structural context that I described very, very rapidly 1 minute ago, what's the cyclical pros and cons? What are the cyclical breaks or cyclical tailwind versus headwinds? Now, very clearly, and you see that on the left-hand chart of the slide, real estate investment or the real estate sector situation remains a very significant hindrance or break on Chinese growth. You see here that investment in real estate is still very, very negative on a year-on-year basis. In July 2025, you have something which is globally at somewhere around minus 12% year-on-year, 12% on a year 2024, which was already very negative. And you have to remember that not only real estate investment is at the apex of a production chain, which represents something like 20% of GDP. And so as long as the real estate sector is in contraction, it's almost impossible to have this part of GDP engineering acceleration of faster growth. You have also to remember that real estate is the major saving component of Chinese household, meaning that as long as the real estate sector and real estate prices still declining overall in China, as long as the prices in real estate do not stabilize and move into positive territories, there will be a cautious saving behavior by the Chinese household. Compared to these cyclical or structural cyclical weaknesses that is reflected in this real estate situation, trade performances have been the one surprising element in this early part of 2025, basically because we all saw this very sharp increase in bilateral tariffs between the US and China. And there was a lot of comments on how strong this will affect China's external performances, with a reminder that net external trade has been a significant positive driver for GDP growth over the past couple of quarters. And indeed, and that was part of our assessment, not to rub my own shoulders, but that China had an ability to diversify its markets quite rapidly, quite substantially. And this is probably what the chart on the right-hand side of the slide does express today, that despite the tariffs that were set up in April from the US, you have had something, I will not say stable, but certainly something that's not a collapse in US dollars exports by China. We are in August 2025 with a year-on-year increase compared to August 2024, which is 4.3%. Not strong, not massive, but certainly not the kind of collapse that some of us will have expected. And once again, I think that the answer to that is not exactly trade diversion, but trade diversification with significant increase, as most of you would know, of trade within Asia, and also significant acceleration with other emerging markets as well as with Europe. So the trade dynamics remains probably slightly more positive, and even we believe that the delayed impact of US tariffs will be felt over the next few months or quarters because of the impact of front loading in the initial part of the year. We believe also that the ability to sharply increase further exports to other areas will be met with further resistance, possibly further protectionist measures, certainly from Europe, but also from some large emerging markets trying to protect their domestic market from a flood of Chinese exports being rerouted from the US markets. So we don't expect a collapse, but certainly we would not bet that the export performances will remain as surprisingly positive as they have remained during the last couple of months. So policies has been one of the elements of resilience for, I would say, for as long as I can remember in my work as a China analyst or China observer. Policies have been very instrumental. Monetary policy, much less than fiscal and administrative guidance. And certainly the fiscal policy is supportive. Overall, government deficit budget deficit will be probably around 5% of GDP this year. And if you add the off-budget elements, local governments, you're probably closer to 10% of GDP in terms of fiscal deficit. So there is certainly a willingness from central authorities in China to continue stimulating demand, both infrastructure and support to household consumption. But by definition, considering the excess debts, that is the most pressing or most dangerous structural weakness in China, there is a strong limit on the extent to which the budget deficit can run. So basically, the structural challenges will remain. Those of us who believed, I would say, part naively, that the shift towards a consumer-driven economy, importing a lot of goods, obviously are disappointed, and the disappointment is probably up to the expectations that were wrong in the first place, because there is no chance that China's authorities want to shift rapidly the drivers of demand towards consumption at a moment of intense strategic competition with the US, where investment in new technologies, strategic autonomy for critical imports, adaptation of their domestic industrial apparatus to move up the ladder in terms of value addition and quality, this remains much more central to Chinese authorities than the idea of propelling Chinese growth with a very strong support to consumer demand. So all in all, that would suggest that we are still very close to the cliff. Are we going to fall off the cliff? That's really the question. Or will the Chinese authorities be once again able to muddle through? And this is, as I mentioned in the introduction, why the use of quantitative tools is helpful, not in predicting the future. We all know that this is not a human capability, but in helping us designing potential likelihood or increasing plausibility of significant events. Now, as most of you would know, we at TAC pride ourselves of having this unique capability of combining fundamental analysis, fundamental economic understanding with very, very heavy investment in quantitative modeling, from simple to the most complex you can imagine. Now, one of the tools that we have is what we call a normative approach to country risk. So it's a fairly, I would say, straightforward approach, even if there is quite sophisticated quants in there. But basically, we ask ourselves as analysts, as country risk specialists, what are the key factors able to deteriorate the economic path of a country? And we have 6 fundamental balances that you see on the spider chart on the left-hand side of the slide. Growth balance, is the country able to have a balanced growth? The foreign debt balance, the foreign liquidity balance, foreign exchange balance, cyclical balance, and banking system. All our metrics are scaled from 0, the best, to 100, the worst, with any metrics above 60 highlighting significant danger. Now, when we combine the performances on these 6 fundamental balance with some sort of, intelligent techniques, we compute an economic and financial risk rating. There again, 0 the best, 100 the worst, above 60 very high risk, below 40 low risk. And this is what you have on the right-hand side of the slide. Now, the comments on that are very straightforward. And again, you don't need to be a Nobel Prize laureate to understand the charts. It's very easy. Here on the different balances, different fundamental economic balances, we have 3 which are significantly worse than the other. This is the banking system, directly related to the excess leverage. Cyclical, with the difficulty of engineering and acceleration in domestic growth, and the persistence of deflationary pressures, and foreign exchange, which might be more surprising, but which is partly related to the reappreciation of the yuan. You can say the depreciation of the dollar during the past few months, but also to the fact that currency competitiveness has deteriorated in China at a time where the apparent stability or the reappreciation of the currency has been propelled by short-term changes in capital flows, with some vulnerability there. So we have 3 balances among the 6, and 3 which are very related to cyclical difficulties. Banking system, cyclical balance, and the foreign exchange and vulnerability to capital flows. These are very kind of indicators of risks for short-term economic development. Now, when we combine them and we have this average economic and financial risk rating, again, average horizon for this rating around 2 years ahead, and we have distinction by horizons. And you see here that we had a significant improvement after the COVID, even with the bump that we had in early 2022. So we had something which moved back from 50 to somewhere around 40, so close to kind of low level for country risk. But the one thing that caught our attention is the speed at which we had the deterioration starting at the end of 2023, where in just 6 quarters, the trend deteriorated by almost 10 points, which is indeed for us a significant deterioration. So the first element in our diagnostic is that the improvement in overall quality of economic development in China, in the ability to manage the imbalances, this ability had improved substantially post-COVID and has once again deteriorated substantially since the early part of 2024. Second tool, which is probably the most interesting, even if the most complex, and the one having significant black box components that obviously we analysts look with some caution. So here it's a pure artificial intelligence technique with 5 different data mining techniques. So don't ask me the barbarian names of these techniques, but that's like genetic algorithm, recursive partitioning, bagging tree. And I'm sure that the quants will be very happy to share with you, how we design and how we calibrate and how we update these models. But basically, these models are fundamentally based on the assumption that shocks occur with nonlinearities. And most of the traditional Quantitative tools have a lot of linearities in their process. Here, we focus really on systemic shock likelihood with 5 non-linear models. And we have a process where we run independently the 5 data mining techniques. We run them for 3 different types of horizons, and we run so less than 1 year, 1 to 3 years, 3 to 5 years, and we run them for 3 different systemic shocks, cyclical shock, so a massive contraction of GDP, a massive reversal in GDP growth, systemic shock on the currency, more than 20% depreciation in a rapid period, and external debt or transfer risk, so the inability of the country to meet its external debt obligations. So we have 3 types of shocks. For each type of shocks, 3 different horizons, and we have specific combination of data mining techniques for each of these 9 signals that we produce. Now, the table on the right-hand side, and I have to confess, I didn't ask the green light to the team, to Sandrine and Leah, to publish that, because usually we don't publish it. This is really the engine of the signaling tool that we have. And you have the cyclical crisis with the horizon. That's the first 3 columns. Then you have the exchange rate crisis with the 3 horizon, and then the transfer crisis with the 3 horizon. Now, the way we use that is that we need to have at least 3 models converging in any one of these column to raise a flag. But we have 2 types of flag, a kind of yellow flag and a red flag. The yellow flag is when 3 models converging, saying that there will be a crisis for a given horizon and a given type of shock. In this yellow flag, the probability occurrence, if we look at backtesting, is lower. So it's somewhere around 80%. So 20% of the cases, we have a wrong signal. But there is almost no crisis that we miss. So this is why we call it a watch list indication, meaning we are not completely sure. Not to say we would be completely sure with a full-fledged signal, but we have more confidence. So we are not completely sure, but we're inclined to believe that the risk have been, the probability again moves from, let's say, 1 out of 2 to probably 4 out of 5. When we have 4 or 5 models converging, then we call it a full-fledged crisis signal, and there the probability of occurrence move above 90%. But we have to be honest and say that when we have a crisis signal which is more severe, sometimes there are crises that our tools do not capture. Here in the case of China, and again, I'm not commenting, just a couple of comments. First thing is that there has never been any signal whatsoever, any one of the 5 models that has been signaling any external debt difficulties. And I guess that's no surprise for anybody, meaning that foreign currency investment into China, having ingrained a transfer risk, these transfer risk remains almost 0, barring obviously geopolitical issues. Conversely, at least since 2020 Q3, which is the starting date of the table that you have on the right-hand side of the slide, you see that we have permanently a couple of models putting some sort of flashlights. And the red number, and when we move above the threshold, so we had 3 for the first time in 2023 Q3. And you remember, this is the moment where the rating started to deteriorate. We moved from 2 models indicating a cyclical crisis for the longer term horizon, 3 to 5 years, and that has started and that remained for 6 quarters in a row. Now, we didn't raise the flag because we traditionally wait for a time relay with the signal 1 to 3 years. And you see that there was some sort of lights, 1 model flashing a crisis, then 2 models in 23 Q4, and then just the last quarter, 2025 Q2, we have the 3 models putting a perfect time relay, the red boxes are the times that are consistent with the signal. So the period of likely crisis consistent with the timing of the signal. So here we have there again a pretty scarce, a pretty rare occurrence where we have a perfect time relay for from the 3 to 5 year horizon to 1 to 3 years horizon. And as you see, if you take the a kind of intersection of the two periods that are likely here, it's basically the risk of a significant cyclical shock in between 2026 Q4 and 2028 Q2. So for us, this relay and the fact that we have the three models for the two different horizons is a very strong, let's say, element of trust in the result of the model, knowing once again that we still do not have the 4 or 5 model converging. So there is still an uncertainty. There is still 20% probability that nothing will happen. But at the same time, the watch list, if you're a hitchhiker walking very close to a cliff and somebody tells you that there is a much higher likelihood that you fall aside, well, you start thinking about, how to protect yourself. And the third quantitative tool that has been converging in terms of risks for the economic growth and therefore for the debt sustainability is a completely separate tool that we use for forecasting GDP growth up to 7 quarters ahead. And this is what we call a recursive partitioning model. You have the example here for the 7 quarters ahead with a quality of prediction which is fairly impressive. 95% of the case we are right when we use this recursive partitioning. And the recursive partitioning model, the way we illustrate them is exactly like a decision tree. So for instance, here, GDP growth year on year, the first condition, for predicting the GDP growth year on year in 7 quarters from now would be to look at the price of the Brent. So we have a condition. Is the price of Brent above $87, $88? Yes, you go on the left-hand side. And no, you go on the right-hand side. And then you have another question. Let's say if the Brent was above, let's say $90, we would go on the left. The next question would be the growth in retail sales. So I'm not going to detail the secrets of the recipe by explaining all the different indicators, but let's look where we are now. So when we run this recursive partitioning today, so the Brent price obviously are below 87. And by the way, we certainly do not expect them to move back up above $87 anytime soon, certainly not in the forecasting period, let's say up to the end of 2026. Then, and that's probably the most important thing, the next variable is the export growth in dollar terms with a threshold which is 6.3%. And these are quarterly data. Today, we are not above. We move there. So we were not above in the first quarter, and therefore we move there. The level of reserves, and then we move to this range 3, which is a, let's say, slightly positive, slightly above potential growth, basically. So growth would remain slightly above potential growth. The question we have is, if, as we expect, we have a change in the export value, the risk is that we go very rapidly to this one thing, which is the lowest growth, the lowest range, and which imply at least 1 or 2 quarters of negative quarter-on-quarter GDP growth. Once we've said that, just to conclude on the then what. So basically, we can have a narrative using the quants and the fundamental analysis. We have a narrative that can be described around 3 scenarios. The first one would be obviously that our signals prove wrong. That once again, the Chinese authorities are fully aware of what I'm sharing with you. They know that a significant or an excessive cyclical slowdown in the economy would create much more debt and sustainability issues, and therefore they could have a view that they keep the hands on the levers. Any hint of a small, vicious circle setting into motion, they would step in. So the idea would be the progressive absorption of excess leverage, the successful, this is the fashionable word, as you all know, involution, which means reducing competition between companies that have made excessive capacity expansion in the recent quarters or years. So you have a progressive absorption of excess leverage, allowing some bankruptcy, some restructuring here and there, the real estate obviously, but also probably some other things. Reducing the deflationary forces by reducing competition, basically, and reducing competition means encouraging industrial restructuring, the large ones, the healthy one, buying the smaller ones, and progressively shading off some excess capacities, and pursuing or continuing a very strong support for the structural transformation that the Chinese authorities wants to achieve, meaning technology catch-up, defense support, move upwards in value chains. And basically you say, well, you have a very efficient, what we call authoritarian strategies, and that manage like small levers of policy actions here and there to allow this progressive absorption of leverage, successful reduction in deflationary force, with a persistent support to demand through the structural transformation towards high-tech defense and higher quality products. And that still remain a plausibility. Now, obviously, the two others are if our signals prove correct. Well, obviously, if the signal proves correct, the one scenario that must be considered, because even if we are not sure, the risks are sufficiently high to suggest that you prepare for the worst. That would imply a cyclical shock as we define it. We need to have a GDP contraction year on year for at least one quarter, and we need to have at least 5 percentage point difference between the 4 quarters ago and the quarter of the crisis, meaning that considering our current scenario, that GDP growth will stay around in between 4.5 and 5% this year, a cyclical shock would imply 0% growth at least for one quarter and negative quarter-on-quarter growth for at least 2 quarters during this recession period. Now, this is significant shock for any country, and certainly for China because of this level of debt, which makes even a couple of quarters of negative growth in very low inflation, probably deflationary situation, almost unsustainable for the companies that have incurred this level of debt. So in that scenario, you have a major wave of corporate and industrial restructuring with significant increase in corporate defaults, implying significant difficulties in bank balance sheets, implying systemic risk in the financial industry, implying selective support to systemically important institutions by the authorities. So basically, you as foreign investors, both on the financial markets and industrial service operators in China, or working with China, you need to know that the likelihood of such a scenario has increased significantly for 2027. And that would be associated in our scenario with a depreciation of the Chinese yuan. And there is a third scenario, which we've not explored in detail because this is much more complex to do, but I think we need to do that, is that the Chinese authorities will want, quote unquote, at all costs to avoid the cyclical shock. And one of the strategy that's to us could be the one that push the day of reckoning further down the schedule would be to use the political situation and probably tensions with the US and obviously sort of nationalistic flaring up under an increasingly authoritarian regime And that, as in many countries that we see that want to avoid the dire necessity of domestic rebalancing, domestic restructuring, they take the dangerous route of international scapegoating. So the problems of China would be related to the fact that the world is antagonizing China, and there will be the need to. So nationalistic stance in the current unstable world that we have would probably include plausibly attempt to, I would not say capture Taiwan or seize Taiwan, but do something more visible, kind of nationalistic drive to reunite China in its grandeur by some sort of operation, military, diplomatic, whatever, blockade around Taiwan. And that would, kind of allow some sort of fiscal engineering and move away from the cyclical difficulties. Now, none of this scenario is a positive one, especially for both foreign investors and foreign operators in China. Whether it's a plausible blind run in international confrontation with the West and the US, certainly part of that confrontational stance, or whether it's a domestic only restructuring of corporate sector of industry and substantial systemic difficulty in the financial sector, that would spell a lot of difficulties for the foreigners operating in China. Now, before I conclude with operational issues, one very important remark. Even a significant cyclical shock will not erase China from the map. China had a very successful authoritarian strategic move that has transformed and that is today continuing to transform the country beyond what we have imagined before and beyond what probably we consider today in the new technologies, in the environmental issues and so on. And there's a lot of elements, including the stance that China is taking today or these days at the WTO, that need to tell us that the cyclical shock that is likely to occur somewhere in 2027 will also fade away after that. That is, that would provide, you could say, from a macro perspective, once in a decade, opportunity to clean the books, obviously with a cost for the budget, a cost for the creditors, a cost for the partners. So we have to remember that even if China registered this massive cyclical shock, after this cyclical shock, you will still have the largest or the second largest economy in the world cruising at somewhere around 4% annual growth for the next 5 years. And there is no competition for that, neither US on the one side, neither India on the other side. So China will remain one of the strongest engines in world growth past this required cyclical and financial adjustment. Now, operational implication, and again, operational implication by definition are very related to each individual corporation or investors' perspective, operation, funding. So TAC Economics would be obviously delighted and certainly able to help you in thinking in details. What could be the implication of such a scenario? What is the degree of uncertainty for your own issues? But let me share just 5 critical considerations just to put a seed in the ground for your thinking. First thing, which is a massive element for us, is that this broad macro picture is an obvious excessive simplification considering massive heterogeneity of performances across industries. You have the quote-unquote traditional industries suffering a lot, mining, steel, chemicals, where profits have been declining, negative. So the profitability that was low has been declining, now negative. And these industries are highly capital-intensive industries with piles of debt. So they are the kind of first candidate for very significant restructuring. You have also a couple of new industries, solar, renewable goods, where excess capacities is huge. Also, certainly automotive, where excess capacity is significant. But you have other industries which are faring very, very well. Components, electronics, services. So very strong heterogeneity. So depending on the industry in which you work, depending the type of corporates with whom you have relationship or in which you invest, the same macro scenario of a very significant cyclical shock will not have the same implication. Second point is, we all know China still remains the major goods providers for the rest of the world, remains the largest exporter in the world, even after reducing significantly Chinese market share in the US. It remained for the rest of the world by far the largest supplier of industrial and consumer goods. And meaning that if you have a cyclical shock with massive corporate difficulties, supply chains are very likely to be tested. Some industrial operations will be very significantly affected, will be interrupted because you have a bankruptcy and you're negotiating a bailout and you need to find some larger corporates willing to buy you, and maybe to have to reduce the debt, discussion with the creditors, blah, blah, blah. So this means that the supply chains with China as a major source of inputs for any industrial organization has to be very thoroughly examined in the assumptions of a significant cyclical shock to see whether your suppliers and maybe the Chinese suppliers of your suppliers could be immediately affected because the sectors or the corporates are in the eyes of the cycle. The third one is that in a cyclical shock, obviously you have consumer confidence usually declining substantially. And this decline in consumer confidence occurs in a moment where the shifts in consumer preferences are very obvious. Those interested, there has been a very interesting McKinsey report recently on these shifts in preferences, which are very, very impressive in terms, for instance, of brands. So the movement away from foreign brands is accelerating. The sensitivity to prices is also increasing. The shift from goods to experience, quote unquote, to use the McKinsey terminology, is also increasing. So that means that in the cyclical shock that we are not forecasting, but that the plausibility of which has increased, these shifts of consumer preferences will accelerate. And for any consumer good, fast-moving consumer good company, this has major consequences on the marketing, on the branding, on the pricing, and on the distribution retailing strategies. The fourth operational consideration is that any operation through a joint venture will be much more difficult to manage in this cyclical problem, especially if it's in industries that are directly affected by the excess capacities and need for restructuring. And obviously, we have in mind, for instance, automotive, where all foreign automotive manufacturers operating in China are in joint ventures with mostly state-owned or large domestic firms. But these firms will be affected. They will probably have a very significant restructuring. If you take the whole automotive industry or the number of car manufacturers above 100 in China, there's no country where you can have on a long-term basis more than 100 car manufacturers. So we'll go down to the levels that we have in the other large automotive market, maybe between 5 and 10. Now, it means that some of your joint venture partners will disappear. Some of the domestic Chinese names in automotive that have not turned rapidly to electric vehicles, that have not adapted to new technology, that cannot meet the consumer demand as it is rapidly evolving in China, they will probably disappear. So that obviously would create substantial challenge for foreign operators operating in a joint venture element. And the last one, if you have a very sharp cyclical shock with adverse perception the likelihood of a currency depreciation increases. I mentioned that despite having very large external surpluses, the analysis of currency competitiveness is not that favorable compared to the South Asian partners. Tariffs act also as a incentive for currency depreciation, and therefore it's very likely that the cyclical shock that we see for 27 would be associated with a period of accelerated depreciation, coupled with increasing financial repression. Financial repression, this is a broad term for meaning larger interventions of the state-owned apparatus, both the central bank, the sovereign funds, the state-owned banks, into financial and monetary systems. So this means that, for instance, allocation of credit might be very much subjected to political or let's say a strategic decision by the central authorities that might imply, and again, depending on your individual situations, very tough or very strong difficulties in accessing local funding, which would imply for most of the foreign operations relying on foreign funding either from mother company or foreign banks. And obviously foreign funding in the context of currency depreciation is never something that a corporate likes to do. So I will skip with the probably incentive of the team, I will skip the last illustration so that we can move to the question and answers. So thank you very much for your attention and patience, and probably the shift to the questions, remark, challenges. So back to you, Morgan.
Thank you so much, Thierry, and thank you for the timing, almost respected. So yes, as you said, let's start the Q&A session. I have quite a lot of reactions and comments. So let's begin with the first one, dealing with the stock market development, Thierry. How do you see the recent stock market development in China and its impact on the domestic consumption in the coming months, years?
Well, we don't do stock market, projection, and even less stock picking. But the one thing that we can say is the Chinese stock market has been, let's say, massacred in the previous period, and therefore it was no, I would not say it was no surprise, but certainly the fact that we've seen the Shanghai Stock Index rising significantly since the start of the year, after more than 2 years really in the doldrums, you can probably say that it's partly a catch-up factor. Most equity markets worldwide have performed pretty well during this period, and Chinese relative performances has been correct. Therefore, Chinese economic performances have remained correct. Therefore, there has been this recovery, again, partly a catch-up phenomena, partly also related to the fact that the worry about the immediate impact of the US tariffs, about the US-China confrontation, has been kind of softened, not only because of Mr. Trump, reversal and uncertainty, but certainly also because the global perception has shifted from seeing China as highly vulnerable to China having most of the cards in their hands to negotiate with the US. And probably the agreement that has been announced with the details about TikTok is, in exchange for a couple of large, high-level meetings, and certainly negotiation for the tariffs and for technology access. I think we tend to see that as a success for China, not for the US. And therefore, part of this improvement in the equity market might be related to these two simple things. You have the market that was, again, completely forgotten or negatively viewed for 2 years, 2023, 2024. And then you have this combination of supportive policies domestically and the catch-up, and then the lower than expected impact of tariffs, plus the fact that if you look at the technology abilities, China is certainly one of the countries where you would like to invest in the high-tech industries, because this is where the things happens. The question, is it enough to trigger a change in confidence, and is it long? Is it going to last long? No, for these two questions, I would answer with a cautious no. Can it last long? It's difficult to say in a context where profits globally are declining. Aggregate profits for the industrial sector, if I look at my data, year on year, if you accumulate that for the 7 first months of 2025, we're minus 2% in terms of corporate profits. So it's fairly difficult to see the stock market extending the gains only on higher multiples. So in that sense, I would believe that the sharp increase that we've seen, I'm not saying that it cannot go further, it has no leg, but it's certainly not going to be supported by much higher earnings globally. And again, that means that I insist on the sectoral or corporate heterogeneity, which means that there might remain some corporates, sectors that are still attractive in terms of valuation, but by and large, the valuation now has moved back to something, let's say, more consistent with the fundamentals, and with industrial profits under very, very substantial pressures, meaning that we don't believe it can be long lasting. Now, can it create a recovery in confidence? Not that much either, because the households do not have a large direct equity participation in their global saving, in their stock of saving, in their wealth, and certainly much less than the real estate assets. So as long as we don't have the recovery in equity prices mirrored or paralleled with an improvement in real estate prices, consumer confidence will remain, I would not say completely locked down, but certainly will not improve very substantially. Hope it clarifies the issue.
Thank you, Thierry. Another questions. Don't you think that given what's happening globally, China will try to do what's needed to prevent its economy from being hit hardly, even if it's challenging?
Well, again, that's the debate that we all have. Resilience capabilities, reaction capabilities, the very, very sharp understanding of the Chinese authorities of their situation. And there, if I share just personal things, in my professional career, where I meet a lot of officials, policymakers. There are very, very few countries where I systematically find that the Chinese know better than us. They are not blinded, on their challenges. They know exactly what happens. So in that sense, you're very right in questioning. In the global context, why would China not resist at all costs a cyclical shock? And if they want to resist, do they have the means? So I start with the second part of the question. Do they have the means? Probably yes. But they are less and less efficient. So you can still make some very significant fiscal impulse. But when your aggregate public debt hovers around 80% of GDP, there's not that much you can do in terms of fiscal support without creating more problem down the road than the problem of excess leverage that you're trying to solve today. Monetary expansion, well, yes, but the interest rates are very low. Deflation is there. So if you have a cyclical decline, excess capacities are there. So all that makes the monetary leverage very, very difficult to activate. We're in a clear liquidity trap. So in that sense, monetary policy has a very low efficiency. The one that remains is administrative guidance for state-owned enterprises, for state-owned banks. So that's what we could put under the financial repression factor. But there again, so it is feasible, but it's more difficult than before. The more sensitive question, at least in my mind, is will they want it? Now, I may sound provocative by saying that, but let's try to put ourselves for once again in President Xi Jinping's shoes. He knows, And all the team, the governing team knows that they have this excess leverage. They know that they need to clear that up before they move forcefully to their next stage of development, which is the central objective of President Xi Jinping. Investing massively in AI, in computer, in the next generation of pharmaceuticals, in augmented human health. Well, the whole thing of this tectonic shift of a wave of disruptive innovation. So the authorities know that they need to clear the deck before they can be fully successful in this critical central strategy. Now, the tariff threats will be behind us, because so that there will be, we expect at least, that there will be some sort of stabilization in the global trade with persistent constraint on technology access and blah, 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 put by the US authorities, and a sort of reshuffle, including, trying to look like the multilateral, champion. So at this stage, the international environment will not be as hostile as it was probably this year and remaining until we see an agreement with the US. So kind of the sort of international uncertainty will be behind. They believe that they can start, some sort of, parking somewhere, resolution trusts, they will park somewhere some of these non-performing loans that will show up in the case of the cyclical shock. And I believe that, if President Xi Jinping is confronted with an idea that he can clear the deck in a less uncertain environment in just 1 year, so let's say during 2027, you clear all the excess debt, you have a large wave of bankruptcies, you engineer that in such a way that you keep your national champions alive, and you try to make the foreigners pay the most for the restructuring, be it in industrial terms or in terms of financial. And then you clear the deck and you start the strategy. Would you prefer that or keep the heavy weight, slowing down your catch-up strategy for many years to come with some sort of lower efficiency support to avoid a cyclical shock? So to me, the timing, 2027, would be probably the good moment for accepting the pain of a cyclical shock if you believe that the pain will be short-lived and that post the cyclical shock, you start with a sort of clear deck. So that's for the intuitive and quantitative answer.
Thank you, Thierry. I have many questions or comments, so maybe I will just select one or two questions. And I know it's not easy, Thierry, but try to be a little more concise for our participants. Okay, so let's move with the following one. Which countries would be the most impacted by a Chinese recession?
Okay. Maybe you can give me one, or if there are a couple of questions related to international trade, maybe I can take the thing on international trade.
I will combine with the following one, which is quite interesting. Between China and the US, do you think which one is closer to the cliff?
Well, the second one is a funny one, and fortunately, Leah, our chief economist, is close to me, so she might be the one to answer whether the US is close to the cliff. I would suggest it's probably close to a political cliff. Now, whether this will have a translation into economic crisis, that's not our central scenario. And I believe that China is probably more difficult to manage that because they don't have the kind of political theater, kind of diversion from the fundamental issue. So with your permission, it's difficult to say, but the question is interesting. US is a major interrogation mark for the global scenario, but not for the same, let's say, economically related questions. Now, for the countries most impacted by the Chinese slowdown, I think we have to look at two different angles. There are the countries that have China as a major customers. For them, obviously, so countries and industries. typically Germany will suffer more than, let's say, Hungary, for instance, because in Europe, China is a major market for Germany, and less so for the other European countries. Asia at large, and especially Southeast Asia, South Korea, even Japan, would be substantially affected because their exposure to Chinese demand is very strong. And if you have a decline in demand with a continuous policy of import substitution, that could be very, very significant for Asia. Now, similarly, a significant economic shock in China implies significant decline in commodity prices worldwide. And that means that all commodity exporters, especially mineral commodities, probably more than the agro-food industry commodities, but the mineral industries, so all countries depending, on export of minerals, probably for the oil prices also, you could have a significant negative shock on prices related to the Chinese slowdown. And then there is the question of how China could try to develop or to support exports to compensate for the domestic weakness. And that, I would say, probably Europe is more vulnerable there. And I would assume that the trade policy of Europe in this context would toughen up vis-à-vis China, unless there is a broader agreement signed between now and then. So that's as concise as I can do.
Thank you very much, Thierry. I think it's time to close the session. Thank you so much for the participants for joining us today and your great questions and comments. As I mentioned earlier, the replay and slides will be emailed to you later today. We look forward to welcome you to our future webinars. And in the meantime, for sure, if you have any follow-up questions on China or other emerging countries, as we monitor more than 100, so please feel free to contact us, and it will be a pleasure for us to give you answers and insights. So thank you again for your time, and have a great rest of your day. Bye-bye.
Thank you. Bye.